Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the MarketSite studio, we have Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for a review of technical levels to watch in the Nasdaq-100 as it continues to virtually climb every day, which is certainly a different picture than it was in 2022. And Brian, I think really what the question is this sustainable at the rate that we're going?
We're coming off, a pretty sharp correction last year, quote unquote correction on what you want to call it. NDX, many other indices were down over 25-30%. So is it sustainable? That's the big question. Are we building the foundation where we're in the early stages of a new cyclical bull market, or is this just something, a temporary relief rally between, what potentially could be coming down the pipeline, which is, the oncoming credit cycle and the impact of these rate hikes, which is a lag. They typically take more than 12 months, and so that's the concern that maybe we have coming down the pipeline in 1 or 2 quarters ahead.
It seems as if the market is, earnings are okay. Nothing really to write home about either way or the other, but it's just so fixated on everything that Powell says. And it's only with how the market's interpreting what interest rates may look like. And it seems to be that's where all the juice is coming from.
Yeah, Powell certainly, and the Fed is, they're very impactful. And, last week when we spoke, my expectation was that he was going to be speaking pretty hawkish at yesterday's meeting, simply because of the impact that the higher equity market, lower rates, tighter credit spreads, weaker dollar, which is what we've been seeing for quite a few months now, how that has on the financial conditions index, which it eases financial conditions. And I think the interpretation from yesterday's commentary from Powell is that he's, I think, less concerned about financial conditions right now. He did acknowledge that there's disinflation, which is somewhat obvious. That's not a decline in inflation, but a slowdown in the rise in inflation. So he acknowledged that, and he had some other commentary as well regarding the whether or not they'll over tighten. So last year when he spoke about how far is the Fed going to go, he said we'd prefer to err on the side of over tightening, and he made some comment yesterday saying that the Fed's goal is certainly not to over tighten. So I think those two comments in his remarks really saw pretty strong reaction in the equity market.
It did. It was like 246, 247, where you saw that headline come across that they don't anticipate to tighten more than they said that they were going to do. Let's take a look at the Nasdaq-100, though. I want to take a look at some fresh technical levels, because when you and I were going over the charts this morning, they certainly have broken through some of the levels that you've been discussing.
Correct. So you can see here, we're testing this pivot from September of 2020. It's not what I would call a major support, but because over the last few months, the Nasdaq-100 has been holding that level, and it's tested it a number of times. It tested it initially back in mid-October, and now again here in December, 2 or 3 weeks in a row. We've held that support. We've bounced higher, and if we zoom in a little bit, you can see, we clearly last week broke out above the 40-week moving average. It's very similar to the 200-day, almost synonymous. And then this week, we're seeing that strong upside follow-through. So that trend, for the first time, we're seeing that break above the 200-day or the 40-week moving average. That's a difference. We've also broken above these highs that were made in December, and so that potentially is a break of the trend of lower lows and lower highs, and maybe we're on a way to a new uptrend, depending on what your time frame is there. So if we zoom in here now on the daily period chart, we can see that double bottom that was formed in the fourth quarter. We clearly broke out of that last week into this week. The upside measured move is roughly 13,300. We highlighted that last week. That does coincide with the highs from back in August. So that price level is 13,300. That's the next level I think we could potentially be going to. You can see here on the daily period chart, though, that we're now trading at the low end of today's range. So that if it holds right here, and we have a bearish day tomorrow on a shorter term time frame, that would be somewhat of a bearish topping pattern.
Which is interesting, because when you take a look at that chart from a technical perspective, it seems to be, everything's firing on all cylinders, if you will, with the exception of today. But when you look at the bond market, it's telling a little bit of a different story.
Yeah, so the bond market, what's concerning there is the yield curve. If you look at the 10-year, 3-month curve, that, because of yesterday's rate hike, because the overnight rates in 3 months are so close in duration, they go hand in hand pretty closely. And we can see we're now at 125 basis points. So we haven't seen this level since early 1980s, way below the lows from COVID, from the housing crisis, from the dot-com era. So, and that clearly has a lot of people on Wall Street, concerned about the marketplace. That's a leading indicator for many recessions, especially the 10-year, 3-month. Some people look at the 10-year, 2-year, but the 3 months seems to be the more reliable one. So that's concerning. And so I think the expectation is, because there's a lag with these rate hikes, we had 425 bips of hikes last year, but most of that came in the second half from the July meeting through December, roughly 275 bips, I believe that was. In the first 3 months of March, from March through June, we only saw 150 basis point hikes. So we're still, far off from where we can see we can expect the impact for the rate hikes to have an effect on the economy, for corporates, and knock on would be credit and earnings. And so I think that's really where the street is now focused. What's the credit cycle looking like, and what are corporate earnings looking like? As you noted, corporate earnings this quarter, not terrible, not great. Expectations, I think, were relatively low. So,
That's what's so confusing with me, with the way that the market is reacting. I get it's a discounted mechanism, but to your point, these rate hikes really haven't cycled through the system yet, right? They take good, 6, 9, 12 months for this policy to play out. And to your point, we haven't gotten there yet.
Yeah, it's only, it's been less than 12 months. We started in 2 more, we're 10 months into the rate hike cycle.
Right.
And so we're not even 12 months in. The biggest rate of change, or the biggest number of hikes, happened between June and November.
Right.
4 meetings in a row, 75 bips. We're now on our way down from that. So the second half of the 23 will be interesting from an economic point of view, from an earnings point of view. The employment data are still holding up as well. So leading indicators like ISM, new orders on the services, manufacturing, all don't look good. The ISM new orders came out yesterday, was down to around 42, so well below that neutral 50 level. So we're in the contractionary territory, but on the other hand, I should say, employment is still continuing to hold up. If we look at continuing claims, which is right here, going back when we have recessions, we do see a pretty large spike in continuing claims. We don't see that now. We're off the lows, but not dramatically. If we look at that red line, which is what the data point came out this week, continuing claims are still very low compared to any period of time, in the last 30, 40 years.
Right. And just think about it, most of the layoffs have been taking place in the tech sector, and they're always in demand. So it doesn't feel like, it's that drastic as a recession.
Yeah, and there's structural changes at hand here. Since COVID, we have a lower labor force participation. The deglobalization, has companies bringing back manufacturing on shores. So you have the millennium generation. High population. So there's a number of factors as to why you could point to that unemployment is not rising as quickly as maybe it typically would at this point in the cycle. So it just remains to be seen, how that changes going forward.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.